All right, what's up, guys? Real quick video on day trading. As you know, here in TRT, we like to day trade on the 5-minute chart, and we use multiple indicators for entries and exits. Today, as you know, the non-farm payroll numbers came out, and it tanked the market in the pre-market off the data, and slightly overreaction that I thought initially. But once the market opened, your S&P 500 and your Nasdaq had just a large gap that needed to fill. So my first instinct this morning was that in this type of market, the first move is generally the false move. All right, so we try to day trade as much as possible through our EMAs. So here in this video here, the red cloud here, your green line is the 915 EMA cloud and your 3450 EMA cloud. The first thing that I want to share with you guys is that when you get a day like this, and today looked a lot like the prior day on Thursday, where there was this ascending wedge setup and eventually did break out but failed. Okay, so we had that type of move yesterday, but we are having that same type of move today, but at definitely lower levels. But my point here, number one, is to avoid the chop as much as possible. Wait out, a good chunk of the day before you go into positions, because as long as the 9 and 15 trends under the 3450 EMA clouds, you're going to see a lot of chop and a lot of fake outs and a lot of fake breakouts. Okay, so do your best to avoid the chop. Now, this morning, I do have to admit, I took some bad trades myself. They're small positions, but I was very quick to cut them when I start seeing that it was going against me, because what you're trying to do, obviously, as a trader, is to try to catch the breakout or the breakdown, depending on which side you're on, right? So in those situations, when you buy short date options like zero DTEs or even next day or 2 days out, those with these types of candles that occurred today, like this candle here or this candle here, depending on which side you're on, you're going to get stopped out pretty quickly, because they do move pretty fast, especially the short date options. And you have to look at your theta when you're day trading options, especially on the Qs and the SPYs. Now, what you want to do is step back, right? Step back and look at the bigger picture. What's happening in the market today? All right. Yes, we receive bad news. Typically, off bad news, I think we would have gone much lower. Okay. But the market did not feel that the NFP was going to matter that much, because we have other macro events coming up in the next couple of weeks. So, but if you're looking at this chart here, we experienced higher lows, right, ever since the pre-market dip. We dipped down to 286. We had a dip to 288, okay, 289, all right, 290, okay, and 290.26. So you can see that it was doing this higher low type of action, okay, and it was trying to break out of this 291 level, which kept getting rejected, okay. So for me, while I tried to trade, all right, as accurately as I can through the chop, those typically don't work out for me as much as trying to catch a breakout or a trend. Okay. So this morning and throughout the afternoon, you had higher lows. Okay. And we could see that this is obviously an ascending wedge. That could break out. So it's still a risk, right? And all of these patterns that you probably know about aren't 100%. They do break down. Bull flags break down, wedges break down, triangles break down. All right. So this is what we did this afternoon in TRT, is that once I saw that we had consecutive 3 higher lows, I started buying options. But see, here's what I did different this time. In this particular trade, I took 300 calls, a little bit out the money, but I took them for December 14th. Okay. So it gave me about 2 weeks time where each candle wouldn't fake you out. Does that make sense? Because the last thing you want to do is you want to go zero zero DTEs on a chop, and every candle can move your option premiums by 20, 30%. All right. Those will absolutely, if you're a newer trader, that's going to wreck your emotions. Okay. So you don't want to put yourself in that situation when we have a choppy day like this. But what you want to do is go with your gut, right? That, hey, we have higher lows, all right, throughout the board. And typically this should break out. So we bought 300 $300 calls on 2 weeks out. Okay. And so I started accumulating in this area, waiting for this breakout. It's still a risk, but it's a calculated risk. And we finally did get the breakout. But where was the breakout? Okay. Right here, when it started to break below this line at about 291.67, that was the point where the markets went berserk. And also your S&P 5 needed to fill the gap to 4,077, and SPY needed to fill a gap as well. Okay. So right here, right before this breakout, I actually loaded, in addition to my Qs, SPX 41, I think 4,100 calls, but I loaded them for 2 weeks out as well. I'm sorry, December 12th. Okay. So I went a little bit short on it. But see, that single trade off these candlesticks gave me 60% gains. Okay. You don't have to play zero DTEs to make money. Although on a zero DTE, if you caught that, that would have been probably 300, 400% gains, but I was very happy with 60%. But I bought those long dated calls and I sold them right near the top. Once that gap filled, and on the S&P 500 at 40.77, that was pretty much the run. And you can see here we're pulling back in the after hours. So the point of this video is to show you that if you stay patient enough, and if you play or you trade the long dated options, and when you catch a pattern such as this, it can be very lucrative. It can make your day. So number one, folks, avoid the chop as much as possible. Okay. When the 915 is trending under 34.50, you typically don't have a bull run quite yet. Yet, at the same token, you shouldn't be buying a ton of puts either. Okay. Waiting for a breakdown, because typically in this pattern, the upside is more favored. All right. Number two, avoid short date options. Look at your theta. Okay. Your zero DTEs has very, very strong theta, and you should avoid them as much as possible, unless, of course, you're going for the fastest scalp ever. All right. Accumulate long dated options when your higher lows are confirmed. Okay. If you're a bear, you want lower highs, right? At lower highs, you would be shorting every pop. If you think that there's going to be a breakout on the upside, you should be accumulating long dated options as long as the higher lows are confirmed. So I hope that was helpful. If you feel like this video is helpful, please like the video, subscribe to my channel, or even retweet it on Twitter.